Let's ask David Zervos. He's the chief market strategist at Jefferies. Dave, it's great to have you here today. And the market does appear worried about growth. What should the Fed keep doing or not doing about inflation?
Well, I think the Fed, should worry about, or the market should worry about a Fed that wants to curtail demand. That's what they're doing. They've announced that, and that is to meet these limited supply stories that we've had to deal with since the reopening. So we're bringing demand down, and that's how the Fed is trimming those inflation expectations. And ultimately, let's hope these supply shocks wane and we get actual inflation coming down as well. As of today, it still looks a little dicey out there, but I think the Fed has done an amazing job at anchoring long-run inflation expectations. I think what they did at the last FOMC meeting, responding to that very high print in the University of Michigan survey, which was later revised, but just showing the market how important that anchor is, I think has been a huge benefit to the market, actually. I think it's been a huge benefit to risk assets.
As you point out, stocks are flattish to up since the meeting and since this reset. So you do see this as a positive. But let me ask you the following. What is the Fed? So now everyone looks at the CPI data and goes, well, last month was hot. They went 75. This month is hot. So same thing. But there's been a huge change in what the market is telling us. All those numbers I ran through, the 5-year forward break-evens, 5 to 10 year, is showing basically 2% annual inflation. So what is that pricing in now? How aggressive do they really need to be?
So you could make an argument, Kelly, that what has happened, as you pointed out in your opening monologue with soft commodities and other things, that things have calmed down. But I really think, look, the Fed has the market, and this isn't just the S&P, it's the yield curve being inverted, the 10-year being very much under control, the dollar being strong. All of that is part of the same credibility narrative. I don't know that it's time for the Fed to kind of make a little a pivot of sorts that says, hey, we're winning here. I think you just kind of keep going with the program. You've got a 175 funds rate. You get that up to 2.5, maybe 2 3/4 with a 100 basis point hike, and you walk away from the summer and you get to see what happens in September. You got a long way through there. You'll get a lot of data and you'll be able to kind of keep your credibility going. The market is rewarding the Fed for being very aggressive against this inflation fight. It still has room to run because rates are still technically quite low. So I think there's an easy argument at this next meeting to be sustaining the hawkishness and sending the hawkish message, but maybe throwing a few bones to the market that, hey, we're watching it, we're encouraged, but we're not letting up anytime soon until we really see that we've got this under control.
And there's a couple of categories here. I mean, the labor market, I don't know how you fix that one in the longer run. Housing, maybe that moderates with some home price. I mean, maybe it doesn't because of, some of the upward impulse on rents. So it's morphed, right? It's not as much as it helps that wheat prices and oil prices are down. That is not the whole story. It might not even be the most important part of the story right now. How do you expect the labor market dynamics to play out?
Well, as you know, Kelly, we still have over 11 million job openings, nearly 2 job openings for every one person looking for a job. Last payroll report was not that encouraging on the participation rate side. So we have a very low unemployment rate. We have reasonably low participation. We got a lot of jobs out there. The Fed has an enormous amount of room to run to kind of just get rid of help wanted signs before it needs to really think about, eating into the jobs themselves. So it gives them more reason, I think, to be quite aggressive on this inflation fight. And look, let's not sugarcoat this. We have a 9.1% inflation rate. This is the highest in 40 years. We've got a lot of things, as you just said, that are still very uncertain in the future. This is not a Fed that's won anything yet. It's just, in my opinion, done a very good job at maintaining credibility and maintaining that anchor on long-run inflation expectations. And I believe that the equity market is rewarding that because the equity market believes, as I think the Fed does, that the number one ingredient for long-run sustained growth to be as elevated as it can is to make sure that that anchor stays very secure. And so equities are forward-looking, and they're going to like that. Of course, the Fed can make a mistake and go too far. I don't think we have to worry about that just yet at 175. But let's talk about that in September, October, November. Yeah. It'll be an interesting end of the year. For sure.
We got a full point hike from the Bank of Canada this morning. And because real quickly, I mean, the surging dollar is something you have to pay attention to. But does that maybe take the heat off a little bit? Does a move like that give our Fed the opportunity to go bigger?
Well, in a way, Kelly, well, we could talk about this another day. I'm in the middle of writing a new piece on Europe because I've been in Europe for the last month or so. But I think the dollar strength may be a little bit more to do with some really, for lack of a better word, inept policies coming out of the ECB. You know, you've got a German economy with 8% inflation and a negative 25 basis point short rate. This is just absurd. Yeah. I don't even know what happened to the German economists that I know that would be up in arms over this, or Jean-Claude Trichet even back in 08 or 11 when he was raising rates with 4% inflation. So we may see the second half of this year with other banks like the Bank of Canada and I'm hoping the ECB really start to pick up their pace. And that could be quite helpful for the Fed. If others start to bring demand down globally, and we see global aggregate demand coming down, that could really help with some of this inflation narrative and take some of the heavy lifting off the Fed's shoulders.
Very well said.
I'm very concerned about what the ECB is doing. I find the whole thing quite disturbing. And I see more of this euro-dollar move being a euro move.
No, it very well said. And again, I think the issue is they're sort of staring on the one hand, high inflation, and on the other hand, breakup of the EU, total energy crisis. I mean, like, you know, there's just not a lot of great outcomes right now. And it is shocking we heard so much from some of the German central bankers last decade about, hawkishness and tightening. And anyway, it's very strange times. David, we'll check back in soon. Thanks for your time today.
Always a pleasure, Kelly.